Hello, stock market enthusiasts. This budget might not make the market jump tomorrow, but it strongly decides where your money compounds over the next 5 to 10 years. Now, let's understand this budget from a stock market perspective in simple terms. Stay till the last to understand the highlights of the budget. So, then please do share, like, and subscribe. India's growth story. Still strong, and India is expected to grow around 7% next year. Now, this number might look slightly lower than last year, but remember, most big countries are growing at 1 to 3%. Second highlight, the government finances. Why markets care? The government is reducing its fiscal deficit to about 4.3% of the GDP. In simpler words, government is borrowing less, interest rates might remain stable, inflation stays controlled. This is good for the banks and BFCs and long-term investors because financial stability protects valuations. Let's get on to the third highlight, capex, where real growth comes from. The government is spending around 12.2 lakh crore on the infrastructure that includes roads, railways, defense, power logistics, and industrial projects. This is why infrastructure and capital goods remain very strong themes. Fourth highlight, income tax. And now let's clearly understand why people will have more money in hand. The budget continues to push the simplified tax regime. Here's what changed in practical terms: favor tax slabs, lower tax burden in the middle income ranges, standard deduction retained, and even in the new regime, less need for complicated exemptions and proofs. Now let's get on to the fourth one, which is the STT. Why markets reacted negatively? The government increased STT on the futures and options trading, thus raised the cost of high frequency trading. So what are the short-term and long-term impacts? The short terms are brokers and traders feel the pain, market volatility increases. And what is the long-term effect? Less excessive speculation, healthier markets, and better for the genuine investors. And in simpler terms, trading has become very costlier, but investing did not. Now, let's get on to the most important thing, which is the buybacks. What changed for the investors? Company buybacks are now taxed as capital gains. Earlier, promoters used buybacks mainly for the tax benefits. Now, retail investors get the clarity, promoter lose tax arbitrage, and corporate governance improved. This is a positive structural change. However, there is another view to it. I will discuss this in detail in my next video. Now, let's get on to which sectors look better. We are positive on long-term sectors like infrastructure, manufacturing, capital goods, financials, and we might see a short-term pressure on brokerages dependent on derivative companies. So, what is our final view? This budget does not reward fast money; it rewards patient money. Union Budget 2026 is built for long-term investors and not for daily market noises. So,